Well, with the US real estate market still showing plenty of headwinds, it's certainly an interesting time to start a US property fund. Carson Scott spoke with Justin Beeton from JB Global about why he believes now is a good time to strike.
I'm a contrarian investor, so I look around the globe for asset classes that are fundamentally sound, yet there's a lot of blood on the streets. For the United States property, you look at the fundamentals of the economy. You've got interest rates that are record lows. You've got unemployment at the moment that's going down in the United States.
Well, some would say it's actually uncomfortably high and won't be going down.
Well, it's gone down last night. They announced 500,000 new jobs were created in the marketplace.
But that's 1 month of numbers. 1 month
after 3 months.
The undeclared, though, unemployment rate's more said to be around 16%.
Well, we're at 9.4% now, and it's diminishing. Consumer sentiment is at 9-month high, business sentiment at 24-month high.
And those business sentiment numbers, though, driven higher because they have slashed and burnt staff and probably won't replace them.
Yeah, true, but you've got 90% of the actual employees now that are pretty confident that they're going to be keeping their job. I would imagine over the global financial crisis, if they haven't been made unemployed, redundant, I'm pretty certain that they're going to keep their job.
What is fundamentally sound about a property market that has got a glut in the middle of it?
Yeah, well, you've got interest rates stimulating the economy. Government's piling huge money to stimulate the economy.
But we're talking about negative equity. Why would we go out and buy more property if the house you've already got is less than it was when you bought it?
Well, residential is completely different to the overall commercial.
Yes, but you have exposure to residential, not just commercial.
Yeah, our underlying exposure to the Dow Jones Real Estate Index, which is about 15% exposed to businesses that are directly correlated to residential. You talk about Warren Buffett. Warren Buffett's stating right now that demand is equaling supply across all actual property classes. And pointing to a V-shaped recovery starting now.
So he says the drawdown in inventories is finished. He'd have to be saying that. What evidence does he point to for that?
Well, you look at Warren Buffett. Warren Buffett's sort of a genius. He never points to where he's getting the evidence from.
But investors want to see that. Come on, I mean, I want to see it in black and white, don't you?
Yeah, certainly. So you look at sentiment, the money that's driving into the economy.
Sentiment's like the wind, though, doesn't it? It changes every 5 minutes.
It changes every minute. Yeah, you're spot on. And so many things that can change it. But you look at the problems in Europe at the moment. Many people say the uncertainty in Greece would be enough to reduce the actual consumer sentiment in the United States. Yet it hasn't.
How much about the commercial property story then in the US, from what you're seeing, is a real return to private sector investment? So many of the numbers in the US are still feather-bedded by government stimulus, still in the system, and that program has not run its course. So how do you have the clarity now to be going into commercial real estate, believing the private sector has done anything other than still deleverage itself?
Yeah, sure. One of the stimulus packages that was introduced to stimulate the US property market was a lot of tax credits. Now, they stopped a few months ago, yet we've seen demand still increase despite that reduction. So we had supply, like the average house in the United States was for sale for 14 months, 12 months ago. That's how long it was on the market for. That is now back to normal levels, being around 4 months. So there's a lot of indicators that suggest that US property has bottomed. Just in case, though, with our investment, we're going to have capital protection. With capital protection, to ensure that, like insurance on our car, if the market does crash, we're not going to lose any capital. So that insurance is provided by the Royal Bank of Scotland. So you get all the upside of the US property market, yet none of the downside.
How confident are you that RBS is effectively run by the British government, that they actually know what they're doing? Don't they have their mind elsewhere at the moment, the budget to kind of recast, to balance?
Look, you look at the downside risk of the person providing the insurance going broke. We put it out to 12 different investment banks around the globe. We chose Royal Bank of Scotland not because they were the cheapest, but they were the cheapest when you look at the higher credit rating. So sure, it gives us a lot of confidence that they are owned by the UK government, pretty much.
Justin, when can investors avail themselves of this? When is the deadline? When's the cut-off?
It's open for investors right now. Cut-off is the 25th of June. So clients can borrow the full amount, and for that they can claim a tax deduction for the interest expense. So that's why we're shutting it off this financial year.